Good morning and welcome to this Wednesday, April 19th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, one thing you need to know is it's options expiration week, and I like to call it opposite George week, and for good reason. Market tends to do opposite of what it had been doing. When we get close to options expiration, I'm going to talk about that a little bit today. I do want to let everyone know that we are having our model ETF portfolio draft later today, 5:30 p.m. Eastern. And that is where we will fill out our model ETF portfolio with a number of ETFs, hopefully designed to outperform the S&P 500. We are about to wrap up our latest quarter at today's close. We do have, I don't know, maybe about a 60 basis point lead on the S&P 500. I think we'll probably hold on to that through the end of the day today. That will mark our fourth time in the last 5 quarters that we have outperformed the S&P 500 with a portfolio of ETFs. Normally what I do is I go through, I talk about the themes that I think are at play in the market, what I expect over the next few months, and then I try to put together a portfolio that I think will do well given those themes and that direction in the market. And like I said, we've beaten 4 of the last 5 quarters. We've now beaten 6 out of 10 quarters since we started. And I find that to be pretty good, especially when you consider that most portfolio managers struggle to beat the S&P 500 on an annual basis, and here we are beating it quite a bit on a quarterly basis. I think that says some pretty good things about our process of putting this together. So anyway, if you want to be part of that, you can go over to our website, earningsbeats.com. We do have a 30-day free trial. It is a members-only webinar at 5:30, so you would have to be at least on trial. But I'll show you a little bit later how you can join us for that. In the meantime, let's go ahead and take a look at what happened on Tuesday. Looking at the Dow Jones first. It was a decent day. I mean, we kind of were up for a little bit, down for a little bit, kind of a day, but the Dow Jones finished down 10. Nothing horrible, been in a nice uptrend. Trending above the 20-day, which is above the 50-day. The PPO strong above the 0 line. Same with the S&P. It gained 3 points yesterday. So not a lot, but it is getting closer and closer to this February high of 4,200. I do think that is going to be difficult this week with options expiring. There is a lot of financial incentive for market makers to drive prices lower this week. I wouldn't be surprised to see a pullback. We saw a struggle yesterday. We've got futures down a little bit this morning. We'll talk about what that might look like in just a couple of minutes. The NASDAQ down 4 points yesterday. Mid caps down 3, small caps down 6. There was your big loser for the day. That was down about 0.5%. And of course, small caps still struggling right around the 20-day moving average. Yesterday closing just a little bit below, 4 points below. The day before it was 2 points above. But that's kind of a trendless market right now. But I'm watching the small caps closely because this structure right here has been very similar to other bottoming structures. I've been writing a lot about that of late. Watch, around the 1185 to 1190 area on the S&P 600 small cap index. If we're able to negotiate that to the upside, I think we could be in for a pretty big run on the small caps, but we do need to make that breakout first. Industrials leading from a sector perspective, gaining almost 0.5%. Materials up 0.4%. Energy up about 0.4%. The 2 laggards, healthcare down about 0.7%. Utilities down 0.5%. It was kind of a go nowhere kind of a day yesterday. I would say maybe there's a little bit of a slant to the downside. But it was bifurcated. We had areas of strength, we had areas of weakness, but I do think that the market has a short term. I think the market could struggle here. We're going to go over a bunch of things today, including earnings. I can tell you that the misses on earnings, at least last night and this morning, mostly are coming in the financial area, which is what we should expect. Financials have one of the lowest scooter scores. I don't know if they're the lowest or second lowest. They're battling real estate right now, but it's been, one of the worst areas of the market. But shockingly, and I'm saying this tongue in cheek, little sarcasm, financials and real estate are leading so far this week. They're the two best performing sectors so far, Monday and Tuesday combined. And I just said they were the worst. They had the worst scooter. Remember, it's opposite George week. What's lagging so far this week? Well, what's been the best performing group of 2023? Communication services. Communication services so far, the first 2 days this week, the worst performer. Welcome to opposite George week. Moving on to the 10-year treasury yield. We have the 10-year treasury. Let me see. Did gap up this morning. Coming back down a little bit. Was as high as 3.635. Currently at 3.616. And that is up a little more than 4 basis points today. I think getting to a key area, I thought maybe the mid 360s would be an area to watch on the TNX. We do have recent highs. We have gap resistance. We have the 50-day, which is up at 3.66. All of that kind of coming together. Maybe the top of gap resistance closer to 370. But this is a 365 to 370 area, I think is going to be a pretty key short-term area for the 10-year treasury yield. Right now, short-term moving higher, trending higher. Do we get through that level? I think that will tell us a little bit about where the 10-year treasury yield might go. Moving on, S&P 500. So here, we're in this uptrend, but I'm looking at the overhead resistance from February. We've got less than 1% to go before hitting that. The high close early February was 41.79. We finished at 41.54 yesterday. We reached as high as 41.69. So we were only 10 points away from a key top. This is occurring as we move into option expiration week. And as I told members last night, max pain, or the kind of the point, the equilibrium point between in the money calls and in the money puts, that's probably down another 3.5% lower than we currently stand. So we're probably talking about maybe 120 points or more potential to the downside. I'm not saying we're going to get there, but I do think that this is a week I would be very careful as a short-term trader. Long-term, pay no attention. This is a short-term issue. I think long-term we're going higher. But if you're a trader, you're not, in and just holding. You're trying to catch the moves. I think this is one of those periods as we get close to this resistance level where it probably is better off. You're probably better off being in cash. Certainly, I would avoid leverage because I've been talking to members a lot about how I use leverage in the market, when I get in, when I get out, when I think it's useful. Right now, I think the risks are too high. I would not be in leverage. Not on the long side. If you want to really be risky, you could be in leverage on the short side, but that's completely up to you. I do think that the odds are greater we go down this week. So that's a look at the S&P 500. Now, if I pull up the NASDAQ 100, I want to point out a couple of things. First of all, we already took out the February high. We did that back in March, second half of March, right here. Beautiful move up, nice little cup, handle, breakout. The handle now, or the breakout level was at about 12,800. So that's about 1.5% lower. I would think that there's a decent chance that we go down there. And if that fails, I wouldn't be shocked to see a 50-day test. Check this out. Lower PPO with a false breakout. That negative well, it's not technically a negative divergence because in order to have a technical negative divergence, you have to have a higher close. We haven't closed above this high at the end of March, but we've got an equal high and the PPO is rolling over and it's option expiration week. And we printed a black filled candle. which is typically a reversing candle. And we're coming off of an uptrend. So the odds are pointing. That's the key. The odds are pointing to short-term downside. Netflix came out with their earnings yesterday. They were down quite a bit right after earnings. They battled back, I think went positive. And now this morning I looked, I think they were down $6 last time I saw. But under the 330 level, which I think is somewhat significant there in the short term. So we got some issues, divergences, and I'm going to show you with the chart of the day, a stock that I talked to members about quite a bit last night in terms of negative divergence and a lot of in-the-money call premium. So it's definitely subject to a move lower. But if you are interested in getting this on a regular basis, go over to earningsbeats.com, earningsbeats, both plural.com. Here is where I said earlier, you would need to be a member for tonight's webinar, the model ETF portfolio draft that we do. You can just click on this, get a no cost trial, won't be charged for 30 days. If you don't like it, cancel at any time during your trial, and you will not be charged. But if you want to kind of follow what we do without having to give credit card, without paying anything, I would suggest our Earnings Beats Digest. We come out with charts 3 times a week, Mondays, Wednesdays, Fridays. It's a very, very easy, quick read. It's usually 1 chart, 2 paragraphs. And it normally focuses on earnings. In this case, talked a little bit about options expiration. But normally earnings, the gaps that result from earnings, candlesticks, price volume, moving averages, all the usual suspects. But we try to make it educational. And you can also use these charts sometimes to trade if you want. That's completely up to you. We're not registered investment advisors. We're not recommending. We're not advising. We are educating. If you choose to trade these stocks, that's completely up to you. Anyway, name, email address, hit that subscribe button. We'd love to have you. Also, when we do free events from time to time, and we do a lot of them throughout the year, if you are on this digest newsletter, you will get room instructions to every one of our free events. So another side benefit there. And can't beat the value, costs 0. So let's talk about what I put in our Earnings Beats Digest this morning. It was Nvidia. Why am I looking at Nvidia? Well, Nvidia's had a huge run. I love the stock. I think end of the year, it's going to be higher. I believe maybe even significantly higher. But for now, short term, this week, I would be very, very careful. And that's what I talked about with this false breakout last night. So not only are you getting a false breakout, we opened and closed below resistance, but intraday, it looked like we were making a breakout. Look at the volume. Intraday, we had a breakout. So any individual traders looking at this would likely buy it because it's showing up as a 52-week high, heavy volume. This is a stock that should have taken off, but it didn't, which tells me that market makers were on the other side selling it while everybody else was trying to get this breakout. Now, why would market makers want to do that? Well, let's go over to the cboe.com, and you can go to under data, hit quotes dashboard, come up here, put in Nvidia, click on options, and then make sure your filters are set up like this. And you will get the monthly options, all the April strike prices, the open interest at both the call and the put side. Calls over here, right there. And then these are the puts over here, open interest. And I want you to just consider for a minute that we are sitting at 270. I think we closed at $276. Was that it yesterday? 276.67. Now, anything below 276.67 means if you hold any of these strike prices below that level on the call side, you're in the money. You have value in your options. So we can go from Nvidia 60. I want you to look at all of these call options all the way up to Nvidia 275. Look at how many of these call options are in the money. You know, there's 4,000, 1,200, 23, 27, 2,900, 3,100, 2,300. Let's keep moving. There's 5,200, 3,600, 11,000, 4,000, 8,000, 3,000, 5,000, 3,500, 14,000. Here's another 4,600. Here's 13,000, 11,000 at 265, 10,000 at 270, another 13 or 12,000 at 275. All of these calls are in the money. That's all open interest. On the put side, the only thing in the money would be the puts that are at 277.50 and above. 3,400, 5,300, 1,000, 1,600, 1,100, 600. Do you see the imbalance? For market makers, the further this stock drops, the fewer calls that are in the money and more puts that are in the money. It's beginning to equal. So if we were to drop from 275 to 265, all of these calls that are currently in the money with value would expire worthless if we finished at 265 on Friday. These would all be worthless. All of these others, the value would be coming down. You're still in the money, so you still have value, but they would come down because you're not as much in the money. Meanwhile, the value on the put side would start to increase. And so I always use the analogy of a seesaw. Right now, you know, I'm kind of giving away my age, but right now, the seesaw is tilted to one side. That's where all the in-the-money call premium is. The put side, there's hardly any. What we want to see is it start moving toward equilibrium where on a seesaw, your legs would be dangling on both sides. Now, we're not likely to get there because by my calculation, Nvidia would have to drop by about $40 over the next few days. I don't expect that. Is it possible? Sure, anything's possible. I've seen it happen before, but $40, something big would have to happen. But could it go down 10? Look at the chart again. 20-day moving average is sitting at 266. $10 would just be a 20-day test. We got a negative divergence, lower PPO, higher prices. That always tells me that a 50-day is very possible. That's what I would look for. Center line reset and a 50-day test. 50-day is at 246. That's starting to get a little more interesting. So anyway, when you combine all this, what I'm saying is that knowing this, would you want to buy Nvidia right now? For me, no chance. Zero chance I would buy Nvidia. And I love the stock. And you know what? It might take off and it might be at 290 or 300 in a couple of days. It could happen. There's no guarantee that market makers are going to drive the price lower. But for me, it's about evaluating risk, and I am not taking the chance on buying Nvidia here. All right, I wanted to go through some questions today. Some members have been writing in questions, and to be quite honest, I have almost zero time in the day to answer questions, individual stock questions. It really is almost impossible for me. I would love to answer everybody's questions. But when you look at all the work we put out, all the shows that we do, the webinars and everything else, for me to sit down and start typing out answers to individual stock questions, and I get a bunch of them, it is really hard. I try to answer some when I can, but I figure, okay, maybe on the show, one of the shows, I can take some time. So here is, I'm going to try and go through as many of these questions as I can. These are questions that have come in from members probably over the last week to 10 days. That I have not gotten back to. First one, what does GDX look like? So GDX, this is the Van Eck Vectors gold miners. Obviously, it's broken out recently above this high. So you got $33 at support, the 20-day moving average sitting at 33.27. So that's your key level. My problem with gold and gold miners or any of the miners is that when you look at gold relative to the S&P 500, and we go back a lengthy period of time, look at what happens. We go through periods where we have these little short spurts where gold looks pretty good versus the SPY. And then it's just more of the same. Back down we go. I'm not going to be overly interested in this group until we really start to turn the corner and start to maybe set some kind of an uptrend. I mean, here were a few tops that we had. Here was another one. We got fairly close to that level. If we see gold really starting to outperform the S&P 500 over a meaningful period and above this level, I would be more interested in the miners and in gold in general. I'm just not a fan. I don't think that the short-term strength that we've seen is going to last. And so that's why I would just keep my stop. I'm not saying you can't trade it, but I'd keep a stop in play. If I start to lose key support levels, just remember that long-term relative strength chart is horrendous for the GDX. So any kind of, crack in the foundation on the daily chart, and I'd be out. That's just me personally. Can you look at emerging markets, specifically VWO and EPP? Well, this is going to be a similar answer for you, to be honest. VWO, we moved up, had a beautiful move. And I do think some of the international markets are looking much better than they were, but there's still some that are fighting in terms of relative strength for the S&P 500. VWO is one of them. This is the Vanguard Emerging Markets ETF. I mean, we pulled back. We put in this high around 40, 80 or so, pulled back to a new low. I mean, maybe this is a neckline. Maybe we pull back one more time and then take off. I don't know how it's all going to play out. But again, my problem is this. VWO relative to the SPY, you can see it's not really done a whole lot this year, but let's go back 15 years. Look at this. Emerging markets relative to the S&P 500 have been dropping for 13 years since the end of the financial crisis. I mean, we saw it move up a little bit initially for a year, but ever since then, it just keeps dropping. I can park my money easily in the S&P 500. I don't have to do it. I mean, it's so easy to invest and be very well diversified. I mean, that's 500 of the largest international companies. Just one investment, in my opinion, is very diversified. You could have one ETF, the SPY. My goal with everything I do is to outperform the S&P, because if I can't, then I should just put my money in the S&P and be done with it. Go golfing. Forget about all this stuff. The reason I do all of this is that the S&P 500 is very diversified. And if I'm good at calling market tops and bottoms, I can crush the S&P 500. The VWO is the opposite of that. So if it's not uptrending versus the S&P 500, it's not even something I'm interested in. So that would be my answer there. And I tell you, it'd be the same thing for the EPP. Look at same thing. This is the iShares. This excludes Japan, but it's basically an international ETF. But look at it. It's just not doing anything relative to the S&P. Stick with the S&P. Find things that are outperforming the S&P 500. That's how you beat the S&P. I mean, if we've been trying if we've just been investing in this over the years, dollar cost averaging, that's what they tell you. Just keep dollar cost averaging. Well, this is dollar cost losing as far as I'm concerned. I'm not a big fan of dollar cost averaging. You take something that's not working and you just keep pouring money in it. I mean, eventually over time, if I'm going to do dollar cost averaging, it's going to be with probably the S&P 500 out of in a 401k or something. But again, I'm trying to beat the S&P. So anyway, that's my look at those two. Interesting question that came in. Is the AD line useful on weekly and monthly charts? Now, if you've been following my work, you know that I've really adopted, really since the pandemic. Prior to the pandemic, I wasn't really using the AD line. I knew about it, but I didn't really use it. Didn't have it on my charts. But since the pandemic, we've had so much manipulation from the big Wall Street firms. And honestly, if you ask me what we do at Earnings Beats, I would tell you we're a guidance, research, and education platform. But if you want it in layman's terms, I think it's us against Wall Street. I'm trying to help people that are following the mainstream media and being whipsawed in the market and being led by the nose of the big Wall Street firms. And they're taking advantage of everybody. So I started using the AD line because I thought it was a really good indicator to tell us a little bit about what was going on under the hood of the stock market. And so the reason I like the AD line is because on a daily chart, you have an open and you have a close. One open and one close. I don't like it on other time frames because you don't have one open and one close. I mean, if you look at a weekly, we pull this up on a weekly. I don't know if it'll show the AD. I mean, AD line's probably going up, but I wouldn't pay it. I mean, I just don't know that it really tells me a whole lot. And the reason I say that is because the open is on Monday morning and the close is on Friday. What about the Monday close? What about the Tuesday open, the Tuesday close, the Wednesday open, and so forth? It's not looking at all the open. There are multiple gaps during the week that are factored into the AD line on a weekly chart. The whole beauty of the AD line is it ignores gaps. So if you're using it on a weekly or monthly chart, especially, I mean, monthly chart, you got 30 or 22 gaps, 22 trading days in a month, 21, something like that. But you've got every day's gaps included in the calculation. Again, the daily chart ignores gaps. That's why I really like the daily chart. Asking for my perspective on CMG, Chipotle. The other thing, by the way, answering these questions, if there are questions that maybe other members are thinking about, rather than me just reaching out to one member who asked the question, this way everybody hears the answer. So maybe I'll answer some of your questions in the process. Let's take a look at the relative chart. I like CMG. AD line looks good here. We have broken out to a new high. I would probably like it best if it pulled back to maybe a 20-day test. But restaurants, look at the restaurants have broken out. CMG's doing okay. I mean, since the low back in beginning of 2023, it looks like it's uptrending pretty nicely. So you've got restaurants doing really well, and you've got CMG as a leader and at a 52-week high. And by the way, why would restaurants be at a 52-week high heading into a recession? If this recession was going to be so horrible, have they already built it in? Have the big drop we had in 2022? Did we already build it in? Stock market prices in things well in advance. So I look at the restaurants going higher and some of the more aggressive areas of the market, which have been leading the market by a wide margin in 2023. And I literally laugh when people inside, I laugh when say, what about the recession that's coming? Well, you think Wall Street doesn't know? You think it's not factored into prices already? That's the whole premise of technical analysis. It's the premise behind all the research I do. Learn from past history. Many recessions, the bottom comes in either before the recession starts or certainly well before the recession is over. You find bottoms in the stock market. Maybe I'll try and do a show on that, looking at all the past recessions. I've done it with bear markets. I've done shows, Anatomy of Bear Markets. I did that back in February 2022. I did it for our members, basically to let them know what to expect, because I was looking for a bear market in 2022. So all of our members were really well versed in what to expect. Maybe I'll do something with the recessions as well. It would be mind-blowing. GWW. So this was a recent stock that we had looked at in I think a daily market report. We probably had it out as a weekly trade setup in our weekly portfolio report as well. And I'm going to annotate here because I think when I mentioned it the last two times, It was either right here or right here. And I want you to notice where gap support resides. This is where we gapped up on very heavy volume. We gapped up and we kept moving higher. And what I always say is when we come back down and we test the top of gap support, that's when I want to buy. Now, we could go back down to the bottom of gap support, but many of these hit the top of gap support and take back off again. So the question is, when I say I'm interested in getting out on a stop or a closing stop beneath this level, the question that came in is, when you say closing stop, does this mean if it closes below that you get out the next morning? And this is a question that comes in a lot. Oh, I've gotten this question from members over the last 20 years, ever since we've been in business. What do I mean by closing stop? What I mean by a closing stop is if a stock is violating that level that I point out at 3:59 and 55 seconds, so right before the closing bell rings, I sell. I don't wait for the next day. If you get a breakdown, the next day you could have a big gap down. When I say closing stop, I'm talking about check your stock at 3:59 and 30 seconds or 3:58. Doesn't have to be right at the close. See where it is. And if it's threatening, I mean, if it's sitting a penny below, that's a really tough call. I don't know what to tell you, because the last click, the last tick of the day might hold support, or it might fall and not hold it. If it's that close, flip a coin. I don't know what to tell you. But if you're looking at it and we're at 635 or 633 and we're down a few dollars below the support, personally, I sell at the close, right before the close. That's what I mean by a closing stop. Not, oh, wow, we broke down. Okay, tomorrow morning, I'm going to get out. What I would do is, if I missed the close, I'd see if I could get out in after hours, somewhere around that closing price. That's the way I would do it. All right, the market's opened. I got through a handful of questions. Maybe I'll try and do this a little bit more often. I do want to just mention a couple of stocks that did report. So let's take a look at what they're doing here as the market opens today. We've got Netflix. So Netflix, you can see now down $11, not having a very good day. And this was the recent support around 330. There, your moving averages right around the 330 level. We're below all of that. And I didn't look at max pain for Netflix, but the fact we're back below this support area tells me we could be maybe a little bit more poised for lower prices. How about ISRG? We had a really nice report last night on ISRG. It was up, and it has continued to go up, breaking out. This one looks really good. I love that positive reaction. OMC, I had talked about. I thought it was one of my favorite stocks going into earnings, at least this week, and they did report really nice results. OMC was expected to earn $1.38. They reported $1.56, but it was at a 52-week high going in. We're getting a little bit of sell on the news. I think a 20-day test would be very interesting on this one. This morning, we had a couple reporting. How about Morgan Stanley? You can see that one is down. Abbott Labs, big move up. ASML, this is in the semiconductors, move down there. Travelers, they beat by a wide margin. Nice little gap up there. 4 financials missed between last night and this morning. I'll give you those real quick. I'm running out of voice here. Done so many webinars this week. And allergies. I mean, I don't know about everybody else, but yeah, I struggle with allergies. Let's see, IBKR, they missed $1.35 versus $1.40. That was expected. And you can see the stock down 3%. CFG, it's going to be interesting watching some of these banks. They came in at $1. They were expected to earn $1.11. Stock down 4%. SYF, they missed $1.35 versus $1.37, but they're getting a relief rally. And this is why it's so hard to predict what a stock is going to do after earnings. ALLY expected to earn 88 cents, came in at 82. They missed. They're down a little over 1%. And one outside the financial area, Lithium Motors, LAD, they were expected to earn 864, came in at 844. Big gap down, got some support right in here. We'll see whether or not we can hold around 207. That would be my thoughts there. Quick look at the market and we'll wrap up. Dow Jones down 106, S&P down 17, NASDAQ down 68. So we are getting a little bit of a move down, but maybe a tick back up here. We'll see how the rest of the day unfolds. Just remember, option expiration week, there are a lot of in-the-money calls this week. Doesn't guarantee us we go down. It's just telling us that things are a lot riskier. Be careful out there. Happy trading.